Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive Onyx Capital Group. Got Vincent, Audrey and Ehsan from the research team here today. So Vincent, what are you going to talk about?
It's going to be talking about the Japanese oil and gas industry.
Okay. And Audrey?
We're going to dig into LNG a little bit today and what's been going on kind of recently.
Okay, and this with you as well, right?
We're going to dig a bit
Yes,
together,
there's a lot of topics to cover, so we're going to be...
Within LNG. Okay, as always, just want to talk a bit about the headline oil prices. What's been happening, Vincent, in the past week? You've been away, actually. We'll go to Audrey. What's been happening in the last week?
Yeah, so I think maybe 2 weeks ago we talked about prices, reaching up to like $88 per barrel, but notably I think we broke this down a small bit looking at open interest. So open interest is kind of declining, which was kind of indicative, of that prices kind of rallied on like a lot less liquidity recently. And prices have corrected a lot lower. So we kind of predicted last week in our video that we would see profit taking from length in the market. But actually CFTC data this week did show that, there's still a lot of, bullish interest in Brent futures. And we saw shorts still stopping out of positions, which is actually in contrast to WTI, where we saw, a lot of length exiting the market and shorts starting to come in. And today we kind of saw prices break back below that $84 per barrel level. I think there's really kind of contrasting supply and demand cues at the moment. So there's, talks of, less rigs in the US. So I think US oil rig count is at the lowest level since March 2022. So there was fears that, supply might be dented there. But then there's other rumors of, Iraqi oil, flows coming back through that pipeline that Turkey had kind of banned back in March of this year. So they're kind of contrasting flows. Then there's obviously the, demand. Some people saying, oh no, demand is going to pick up. Others saying, no, demand is not going to pick up. So there's really just contrasting views. I think that's being reflected in kind of market sentiment. It's very much kind of wait and see, risk off, all a bit kind of.
Yeah, I think we had a good run, right? It was like 7 weeks of printed rally.
Yeah.
And I think last week it was the first time that that streak was broken.
They're back up into Monday though, as in they came off on Friday, but again yesterday kind of back up and then down a bit today. It's all a bit kind of lackluster kind of at the moment. There's no really clear macro driver right now.
Yeah. If I can share my screen, so like Brent futures is the front contract. Since the end of June, we had like a really, really good rally. But I think for me, the story was, or chart of the week, if I want to pick something, was the front spread rather than the Brent futures itself. It has been trading into $2 range, but this is the front spread. OCNOV Brent futures, which has come under significant pressure since 15th of August last week, exactly the same date. We were trading around like 75 cents, and we're back down to like around 30 cents now. I think Greg, you mentioned that there was like a bit of fund rolling and also...
Well, that's what's common mid-month, mid-month fund rolling, fund spread. Also, what was the top of the range, like 60 cents?
It did hit like around 70 cents.
Yeah,
70 cents.
This is the other thing. So we'll see the front spread a lot more linked to actual physical differentials. There's actually meaning to it, whereas the Brent futures price is, what is it, Vincent? You call it the equilibrium of buyers and sellers at the end of the day, and it's only ever going to be brought back by a physical differential, which is limited in its range, and that range is the time spread. So the time spread, the cash spread is what I think it was like 40 to 50 cents. Trading around there on expiry last month, and that's when tip of the iceberg of like the whole OPEC situation, the bullish rally in flat price. So basically, if it can't hit beyond 50 when it expires, the confidence kind of wanes of to be buying Brent spreads at like 60, 70, and that's like a very loose definition. But if you're long and it gets to 60, 70, it's probably a good time to take profit. And if the fund rolls are coming in, it's not really too surprising, I would say, on that chart that there's a fair amount of selling coming in.
Yeah, I think that the proof in the link as well that like this was North Sea related was the looking at the WTI Brent boxes, because the spreads in Brent came off like more aggressively, and the boxes rallied. Yeah. So it is definitely like an indication there.
But at the same time, because I'm saying fund rolls and all that, it could be the bottom of the range, right? Because it's just flows coming in and out. We've still got expiry coming up in a week's time, so it's a good time to re-enter once the fund rolls are done. And actually the prompt, so again, about the physical differential and expiry, It then rolls up to the physical differential in dated Brent, and that's now in triple digits. That's about $1. So technically the spread could justifiably be $1 because people can see that it will actually clear in the cash market. It will actually be traded closer towards $1, which will justify buying those barrels on expiry further towards $1. So I think if that can sustain in the next couple of weeks, that's a pretty good sign that the Brent spread people can have confidence to buy the Brent spread up a lot higher. I think a lot of it is like a bit of a psychological thing, this 40-50 thing. So if someone can kind of go, no, I believe in this, and the market can follow through, refinery margins are still really strong. We could have a hurricane that destroys, WTI Midland production coming into Europe. All these kind of things, there's a chance of it. And
so is that a trade idea then?
I think that's a good trade idea.
Ocnov,
Agreed.
Brent futures.
Yes.
Or if you want to be like more protected, maybe like, I don't know, Ocnov deck flies.
Flies. Yeah, that's probably a good shout actually, because it kind of gets rid of the flat price correlation, and it is a North Sea thing. So sometimes even the outright spreads, even though they are related to North Sea, inevitably the financial money weight from related to flat price. People buy and sell spreads as well as flat price, right? So they might not really have any understanding of the underlying physical or be factoring it in, but they'll still trade the spreads on a technical basis. So if you trade the flies, I guess you are kind of getting rid of that. But then again, that assumes that you think it's like an outlier on Ocnov. And I think generally what we're seeing is people believing again in no, it is just general strength. And if anything, maybe still hesitant that it could just be a very prompt thing. But if it can be believed to be sustained, then actually I think you do just want to own outright spreads and not the flies, because it should be a general macro demand, strong market theme. And especially as OPEC don't look to be taking their foot off the gas, and at least until next year, it's probably not a bad shout. And as I say, the potential risk of a hurricane. So hurricanes, it's funny, I never used to factor it in for crude because it was more of a gasoline trade. Certainly created some huge kind of P&Ls for traders in the past on the RBOB spreads and all that. But yes, you can trade WTI on the back of it, but it's not like the most, I don't know, it's never been the most attractive trade to sell WTI Brent when a hurricane impacts production. But it is a trade you could do in the past. But these days, because it can genuinely impact Gulf Coast crude coming to Europe, and that's such a big part of pricing dated Brent now and the Brent spreads, then that is actually quite important. And I think this is the first month ever that we can actually relate a hurricane in the Gulf Coast to potentially Brent spread strength, which it's weird to say. It's when I was trading, it was just never a thing I factored in. So
I think that's interesting, because I think that's two structural changes, because one of them is Midland and the effect on crude with hurricane, and the other one is the LNG flow out of US into Europe as well. That can get affected too by hurricanes. So you see Brent spreads and potentially.
What you're saying, because of the growing importance of LNG, because the West has replaced its pipeline flows.
Exactly.
Yeah, no, good point actually. So
the hurricanes is going to be. There's I think two sides of it, because in the southern part of Japan as well, there's the hurricane watch, and people watch that area too. So
let's talk about that then. The overall LNG. So what is generally going on? I think you have to link LNG and TTF, right? So
even I heard that LNG prices surged last week. That was the big news in the industry for sure. It was around.
You were on holiday,
and exactly. So that's how significant the news was.
Cool. Okay, Audrey, give us a summary then.
Yeah, no, so the big news kind of the last 2 weeks has been those Australian LNG strikes, and I think that's kind of led to loads of different kind of conversations about different things like storage. Everyone's kind of interdependence on the three big players like US, Qatar and Australia. So when the news kind of first broke about the strikes, prices jumped about 40%, and even today they're up at above €41 per megawatt hour in the front. And I think now most people are kind of thinking, even if strikes do go ahead, it'll probably only be a 2-week thing. So the reason they actually want to go on strike is for pay and better working conditions, and it's in everyone's best interest for them to reach an agreement for this not to be a kind of an extended thing. But I guess it started loads of different conversations. So one of the other big kind of news this week is cumulative EU gas storage hit its 90% fullness target. So that was supposed to be reached by November. It's already been reached. We're at 91.34% is the most recent figure we're at already. But actually, in terms of
this has been the highest that it has
it's ever been for
reached
this time of year.
for this time of year. Yeah, exactly.
Yeah, but the thing is, so EU gas storage facilities can only hold about 100 billion cubic meters of gas compared to annual demand in the region of about 350 to 500 billion cubic meters. So that's, dependent on weather conditions. So then there's been a conversation about, looking for more storage. So the EU has started looking to Ukraine for more storage. That has started a whole conversation about, is this a good idea? Can it be relied upon? Will they not use the stocks for themselves in the event that they need it? Will they not, they're not actually on the kind of front line of war. I think they're, a lot more sheltered
So
from
Europe
that.
is at like 400 billion cubic feet deficit.
Depends on the weather, you see, because that's the
Yes.
thing. You can't know. It's going to depend on demand. But demand so far this year to July is actually down 12% in Europe year on year, and a lot of people are attributing that to temperatures and also the switch to renewables. Then there's other articles coming out about all this kind of skiving for more storage is kind of it's just a this year problem that in the future, because of the whole renewables kind of push, that we're going to be looking at an excess amount of storage in a couple of years. That's not actually financially a good decision to do that. So
you're a long way away from the renewables to have like a meaningful replacement for natural gas, isn't it?
No, I agree with that, but these are just all the conversations that are kind of happening at the moment, and I thought it was quite interesting today. So our trading desk do put out kind of things that they're seeing in the windows. So obviously the fear with the Australian strikes is not because it would directly affect Europe necessarily, but what it does affect is Asian players not being able to get their hands on the Australian LNG and then directly competing with European players in the spot market. What was really interesting this morning is there's actually been more window selling from majors and Asian importers. It's
So
really
selling in what?
selling in the window this morning. So that would have been JKM selling.
It's JKM selling.
Yeah.
Okay.
So obviously the basis has come off lower, but it's more on TTF strength, a lot of this. But there's been a lot of these side conversations then happening about, okay, do we need to diversify? And the EU has talked about this, about, I think Russia still accounts for about 15% of Europe's gas. And there was talks about the EU kind of just cutting that off completely so that, if one country does do something or like go on strike like Australia do, so that would affect about 10% of global LNG.
Yeah, it's quite significant.
It's
10%
quite significant,
10% of the total world production comes out of Australia.
Yeah.
Right. And
the problem being, if you're relying, and I guess it's kind of like the oil thing, it's like what we were speaking about with oil, with OPEC cuts. Eventually, are they just gonna, cut themselves out of the market? That people are just gonna start looking to other sources like Canada, like the US. I guess Australia, again, I don't think it's going to be an issue like that yet, but it has started the conversation about, being heavily reliant on, a limited number of countries for your gas.
Yeah, and you've got China ramping up their import capacity, and so all these conversations
That
basically gone.
No, that was quite interesting. You sent me an article this morning actually about like trading.
Reuters did an article on the activity of China. Good that you mentioned. It was quite interesting because like all of the big players who are in the oil space are looking into like opening up offices in Singapore and London to get more active on the trading side of things for gas. So if I can bring that up, and actually we can like have a look through like a few of those names. You can see these are the upcoming LNG traders, PCI, PetroChina International. They've got trading desks in Beijing, Singapore, London, Dubai, Houston, Unipac. Again, like they're quite active in trading gas, and they're getting more and more active. And then these bigger names, but there's like these smaller names too down here, like Jovo Energy, China Gas Holdings, even like the Japanese companies as well. Like generally, like the Eastern companies that who are thinking, or they have already implemented a lot of like trading activity on the financial side of things in gas and in LNG. Is kind of like summarized here, but there's you were saying that China is ramping up, and there's this clear sign that they are just starting to get ready for what's to come in the next 5 to 10 years. And they are seeing like opportunity here, and that's why like they're just
it's a reminder for me. Like we were talking about LNG markets, I don't know, 5-6 years ago, being like, well, the trade houses especially were investing big time into LNG trading, majors and trade houses. So it was inevitable that the derivative market would start kicking off. It's still kind of early in its growth because the LNG market volumes are nowhere near the physical, from my understanding. So, you're looking at oil, it's many times. So I think that's got a lot of growth. People want new benchmarks, and they say these things, but they take time. But I guess the point I'm trying to make is, it's not that surprising that when they put all this investment in a long time ago, that we're starting to see it gain traction. And then, obviously the Russia-Ukraine situation accelerated things, but China wanting to be more involved, more traders. This is just like an expansion of a market. So LNG is just going to be a huge market, but there has been a lot of investment. And it's the same thing, like, I guess, with every other market. So, people are talking down hydrogen quite a bit, but the oil industry wants hydrogen because it fits the oil model, right? It fits the infrastructure they already have, and there's not these drastic changes. So it will come, like whether or not people think it's going to change the world or not, like we are going to get a lot of hydrogen trading eventually. And then that will lead to a derivative market, or a derivative market could even help that growth. And I think these things are like easy to predict because.
So you mean the infrastructure is similar to oil? So why
to transport it? As ammonia and things like that. Right. So it's like, you don't have to make these huge changes. Like with LNG, you have to like create bespoke ships and all that. And you will have to with oil, but I just don't think it will be to the same degree. And there's things, issues like corrosion, hydrogen with Chinese steel. There's a lot of shit that's on a lot of ships and things like that. But they'll get around it. And ultimately what I'm trying to say is like investments, it's like oil tankers, right? Excuse the pun, but it's like one of those things. It's like if you've invested like billions and billions and billions, like it is coming. So we just need to be that way, ready for it. LNG is no different. And then people like hoping for this renewable boom, it will also happen. But it's just, you got it. Like you can see the timelines for every other, commodity or fossil fuel.
I think as soon as like these commodities hit the sea, then like that becomes like so interesting, because then you would have these flows around the world and like create opportunity for like traders to utilize that and
optimize and the rest of it. No, that's what makes it integrated. And that's why pipelines are just pipeline derivative markets are a nightmare to trade,
right?
Because you can't see what's really going on, and someone can literally just turn it off that day. Same with power markets, right? Like hourly
it's
markets.
A lot of centralized like power over like the data that comes out of the pipeline, isn't it?
But as in, anything that moves by ship is slow, right? So it's it just makes more of a dynamic. And then if you've integrated the world like oil has and now LNG is, more and more people are looking for more and more opportunity to trade the disparities between regions, to optimize, to create optionality on the back of their physical contracts. So for example, they've got import-export contracts from US to Asia. That's actually a derivative position you can apply off the back of that, and you can trade around that arb. Do you say, right, I'm inherently long this arb, long US, short Asia? Do I just run that risk, or do I hedge half of it, or do I hedge all of it immediately, or do I use it as to get out of a position that I'm short and I want to get out of this position, so I'm going to book a cargo? That's how oil markets became so intertraded, and that's how these trade houses and majors do so well, right? People love to talk about these guys like they're hedge funds. Like a hedge fund wouldn't take like the type of risk and balance sheet they do on these positions. This is physical optionality of contracts, and whether people like it or not, this is how you get a sophisticated market going. People need to make money from it, is what I'm trying to say. And you tend to be able to make a lot of money from a global integrated system that has a lot of complex contracts and a lot of inefficiency. Ultimately, inefficiency is good for people wanting to trade it because they can see the opportunity, so they trade it. And then obviously laws of economics, it eventually kind of becomes more efficient. But if you want a proper market, that's how you get a proper market. So renewables will be no different. It's kind of my point. But in terms of price forecasting a little bit, like LNG wise, I mean, I guess it's very much hinging on these physical things.
I think there's actually a trade idea there.
Go on then.
Right.
I guess it depends on your outlook though. Do you see Citigroup, their forecast is like €62 per megawatt hour, So that's
For the
like
end of the year.
20. Yeah, for TTF, and that's like €20 from where it is now. Now that's quite a significant rally.
Yeah.
It is, yeah.
Yeah.
I think again, it's like it's quite news dependent, but again, we have to be a bit careful when we talk about LNG and TTF versus the same way we talk about Brent and WTI because of the financialization aspect, right? It's a lot less in TTF and LNG, so you get some serious hedging flow. It can make a huge difference. So whether or not when we say, Chinese are starting to trade more, it could just be, well, look, we're trying to pick up cheap prices and play the derivative curve as a way to lock in forward prices that we know we're going to be buying because we know we've got forward demand, that we just have an outlook that the prices aren't going to get any lower. It could be as simple as that. But that hedging flow will have a bullish impact on the market because hedging flows dominate LNG and TTF. Yeah. Simple as that. So
they have a lot more share on what actually prints up, you mean? Or
exactly. A lot more of of the risk capacity in the market. Hedging flow is a big proportion, if not the major proportion. So if there's a consensus that we are going to be on, because like we said at the beginning of the year, people kind of dismissed LNG and TTF because it's a been and has done type situation, and we're still elevated historically, but ultimately it's unlikely we're going to get back up to the heights. That was the consensus. And now we've had these issues, and now as we're talking about, it's some new supply disruptions can make all the difference. Australia going off, who would have thought? That's like 10% of LNG supply, and I might be wrong on that.
No, it's right.
It's right. And then suddenly, like, who thought if Australians strike, the whole TTF price is going to roof like that? It's just not something that was a thing last year, and now it is because of the share of LNG as TTF. It's crazy, but that's what makes it interesting.
It's quite interesting that like Australia, I was thinking, right, Australia goes on strike, so surely JKM is going to outperform TTF because like they are geographically, it makes sense, the arbitrage for it to end up in Japan and Korea, and that's going to affect the supply there. But in reality is, right, Australia's off, so like you've got these producers who are going to produce who are going to be like taking basically replacing that Australian flow, which is either Qatar or US, and now the US outflow is going to have there's this competition for that flow between Europe and also Japan and Korea, and that's why like TTF like rallied a lot more aggressively. And when I said like there was a trade, and that's quite interesting, is there is there is a lot of consensus that like Australian government is going to intervene and try to like sort this out ASAP, and this is not going to like have a long-lasting effect on the market. But what actually happened price-wise, JKM versus TTF boxes came under a lot of pressure because there was
the boxes
because there was like a really, really good spread buying in TTFs off the back of the rally in the front, and people are just like getting really long the spreads too, and the OCNOV and a little bit NOVDEC as well. JKM versus TTF boxes came in under a lot of pressure, and looking at all the technical indicators out there, the actual flows out there, and if you think that this news is going to go away and people are going to go back to work in those LNG plants, production plants, then this should correct back. So that's the trade
so
idea.
Your logic for TTF outpacing LNG was, what was your logic for that?
TTF outpacing JKM.
Yeah.
So essentially it was, right, now you've got Australia off, and the flow must come out of US, and US can either supply to Europe or Japan, Korea, and the competition between the two, and I don't know, all the political landscape behind this is like,
so you're saying because Europe needs the LNG more than Asia needs the LNG.
Exactly, they're going to be competing for that.
So
they're going to be competing for that, but the competition is going to be stronger from the European side. That's why like TTF got a lot more affected than
and this is what's dangerous
benchmark.
about trading these diffs. Like again in Brent, you trade the DFL, it's a very logical physical differential to Brent. You're trading that, it means something and it's related. And WTI Brent, it's related, everything's very clear. But LNG and TTF, they're as close as you can get in my mind to like two independent flat prices. Like just because one's bullish for LNG doesn't mean you should be buying the LNG versus TTF diff, because they're
JKM TTF.
Sorry, what am I saying?
LNG.
Well, JKM as the benchmark. that's risky, especially when hedging flow is so dominant. So that must be very tough indeed to trade. But from a hedging point of view, like it's good requirements that can come into the market and hopefully lift liquidity and trading activity, because it hasn't been the best market for 6 months.
I think I know what you mean. Like, it took us a couple of weeks, if not months, to believe that, right, we are in a stage that Brent Dubai trades negatively, right? And people have confidence in it and start like really booking
because usually people are like, it's negative, I'm just going to load up. And just, maybe people have done that. But it's looking like it might stay there. Is that what you're saying?
Exactly. As in, like, you see it and you're like, right, this has never traded like this. But what happens in the LNG is like the basis can go negative, can go positive, and it can change like all the time.
There's no ramifications of that.
Exactly, because these are, again, as you said, it's kind of two flat prices. And it's quite hard to have confidence in.
To arbitrage them ultimately.
Yes,
because
exactly.
the arbitrage is like, what do you call it?
Regasification.
Yes. It's that, and it's not as clear. And it's the same for power, right? Like, there's these links to each country's transmission lines, but there's loss of energy during those transmission lines. There's going to be political land discussions around when the transmission lines are. So it just comes back to the same thing. Like, the oil market is so sophisticated because it's been allowed to build off standardized contracts and derivatives that, create all these links and interconnectivity.
But the blueprint is there for these markets.
Agreed. But LNG and TTF, again, though, the physical is not. It's two different products, effectively, right? Even though they're linked, obviously, it's not as clear as day. Once Seaborne was pipeline. It's going to be, if anything, I don't know. People always say things like, "Oh, someone's come up with a benchmark, and that's more reflective, and we'll trade that." But that is just not true. Like, if history is anything to go by, like, why was WTI the one that got traction? Like, LLS started at the same time, if not before, and it made more sense. It was a Gulf Coast crude; it could be exported, even though you were allowed to export. But it was more indicative of like seaborne economics and the rest of it, and it wasn't landlocked. But Oklahoma Cushing, like WTI, was what gained traction, and it just is what it is. Like, it just, So people are trying to change things all the time, but consensus is very, like, forms in herds, and it's very hard to unravel. So will LNG versus TTF ever not be a tradable instrument? Probably not, right? People just like trading it and are used to trading it.
I was going to say, like, we could like go back and think about the success of ICE Merben contract after like ADNOC came out with that, and it's just like, it's very, very difficult to change people's habits, and you never know like which contract and which benchmark is going to gain traction.
There's no winning formula other than, when you do talk to people about this, the general consensus 10 years ago was you convince the majors, you convince the
trade houses.
Probably majors first, right? Because they've got the actual production, and if they have demand for it, and then the oil trade houses who are going to trade the oil with them are like, we like this too, and then there's kind of general consensus, and then you work down the ladder, right? But I think even before you get to market maker, banks, there's all these like tier 2s, tier 3s, whatever. Now it's flipped on its head. They're like, we won't go and we won't trade this unless there's liquidity. And the only way liquidity is going to be there is if the market makers are going to be there. But it's all chicken and egg. Like, sometimes I've seen the most random markets kick off seemingly for no reason, and then they go away, and then they're away. And on the flip side, I've seen markets start and then dissipate into nothing.
Right.
So it's just, I wouldn't even, there's no point. There's like rebates, there's all these kind of things you can do, but people try all the time. I think the one thing people who start new benchmarks have to remember is, I know they know this, but long-term contracts, and you're judging everything based on 2-3 years forward, and you've booked contracts in real terms on that benchmark, and it works and it's not that bad. It takes a lot for you to be like, okay, let's completely shift to something I have no clue if it's going to work, and then book like real money attached to it, like considerable investment. It's just not, it just doesn't really work like that. It's that's why it's better to attack new markets. So hydrogen, for example, the first benchmark of hydrogen, it might be a really poorly formed benchmark, but if it's the first one and people use it and people get used to it, then it will probably likely stay. So it's more to think of it like that.
One question actually here. Is it better when these benchmarks are created for them to be cash settled or like physically delivered, or a mixture of both?
I think like these days 100% cash settled. because we won't trade it if it's physically delivered. Like, it's a nightmare when you have
incentivizes like people to trade it if it's cash settled.
Incentivize people to trade it because, well, I mean, is incentive the right word? It means there's not a fear of trading it.
Right.
Because you're like, worst case I lose money, which sounds stupid, but it's like, yeah, but it's tangible.
Yeah.
Whereas if you're like, if I hold this position and I forget something or my systems aren't correct and the juniors don't reconcile well and the bank doesn't,
I get delivery.
And I get penalized and I get ripped off and I get fined, and you're like, why would I go through all that? And then remember, the other thing about physically delivered contracts is not just it ends in physical delivery. It's the pricing of it is so susceptible to the minutiae of the people that trade it. So you're like, well, why would I want to be involved in that? Like, again, you talked about Merben, like the Merben pricing. If you were to carry it, you can carry future swaps of Merben. And if you carry that into pricing, it is cash settled, but it's related to the futures settle, which is physically related.
Yeah.
And that pricing is like, it could be anything.
Yeah.
So you just don't have enough certainty. The thing about cash settled contracts is there tends to be an equilibrium quite quickly as to what the ranges are of pricing. Of course, there's going to be blowouts, but I think you accelerate the understanding and you definitely accelerate the liquidity.
Yeah.
So
more confidence.
Much more confidence. I don't know why people lead with physical delivered contracts other than, well, it's more related to the underlying, so surely it will work as a derivative contract. But that shows a misunderstanding of what derivatives are all about. Most people who trade derivatives are not looking to trade physical. Yeah. And I think that's too difficult for a lot of people to accept as it stands.
I think it's pretty fascinating about the mechanisms of these benchmarks, and the fact that it works is because a lot of traders, the market, the regulators, they all believe in that benchmark, and that there has to be liquidity in it as well. I recall earlier this year, of course, the TTF, I think there was a price cap was implemented, 180 euros, and that caused for a brief moment a liquidity drought. There was a lot of discussion about how that would impact markets as well. But at the same time, you can also see some benchmarks evolving over time to remain viable. For example, the dated Brent, we saw with the inclusion of the WTI Midland.
Yeah, if you go way back if you know your history with Brent.
Of course, it was introduced in the 1990s, before I was born. And
but it was traded just as Brent forwards,
right?
Which were was only so you could only trade it in 600 kb cargoes,
right?
So it was the flat price, and you could only trade flat price with physical cargoes.
And then
they changed it to a cash settled.
Oh, so before was purely physical, and then became cash settled.
And the whole EFP mechanism, exchange futures for physical, and all that kicked off, and then you just got an absolute liquidity boom.
So it all became traded in relation to forward Brent, right, and all of that. So before it was just purely physical. Right now it's still
It wasn't just about the adding the fields. It was moving from a physical to a cash settled contract.
Right, and that's what allowed the actual derivatives market to really boom, and then that's how
I would argue,
all of that, and then that's, I guess, you entered through the dated was your first entry into the oil market, right? And back then it was like the Wild West. Even though it was, it had both physical and paper, it was still quite like the mechanisms were quite complex at the time as well. You had like EFPs, CFDs, DFLs, and all that to grapple
with. Still has them now.
Still is, yeah.
still is, but now it's more.
What it was back then was, I was looking at Brent Dubai rather than dated Brent, more straightforward.
Yeah.
And then what happened was, I knew about the dated market, but there was the expiry of the Brent futures, which is all links to dated Brent and the expiries and all that. And whilst that was complex and needed to be figured out, it was also actually, on retrospect, looking back to how dated Brent used to price, it was actually one of the big things was the quality premium.
Okay.
Sulfur de-escalator. So they would make all these adjustments for 40s. Basically 40s were set in the print, and then you get new flows like South Koreans buying 40s, and then China eventually in 2016. But when I first started, it was Wild West, because the price, like, there was only a very select number of people who would understand the pricing and be able to influence the pricing and its mechanisms. And the adjustments that Platts have made, I don't think are fully appreciated, because it's not just oil fields. It's the sulfur de-escalator, and quality premiums were brought in to say, the difference between all the grades and making allowances for that to try and even things out. So there's been a lot of like these smart adjustments, because before that it was just like, it was nuts. And then there was also the complication with Brent futures relative to dated Brent. So dated Brent was based on 10 to 30, and then Brent futures was up to the 15th. So you'd only have like a third of the oil, of a third of the 40s available would be used to set the Brent futures price, whereas in dated you'd have a whole month of it. So it was like a disparity between the dated Brent versus the Brent futures. So the EFP's range in like 2015 was like minus 40 to flat. So when you traded the CFDs versus the DFLs, you would have a 40-cent differential. It was not, so you'd be like, oh, I'm getting short at like minus 10 in EFP, and then like you're thinking you're making 30 cents, or you're trying to gauge fair value of the EFP, so you're trading the two around each other, and then it would just massively blow out. And there was hedges like buying the front spread, but it was just basically nuts, but it was obviously good as well if you could figure it out. But since then it's become way more efficient because of all these things aligning. Like Brent futures went to 30 days, and that's why we have, it's 2 month forward now. So it used to be like WTI a bit more like mid-month, so it was closer.
Right.
Oh, it's just a whole nother, I'd have to go into all the detail, but the point is that like those adjustments, like I agree with what you're saying. Basically it's like be really important for more confidence, more liquidity, and all that kind of stuff. So at the end of the day, it doesn't suit everyone, because people obviously like complexity in some respects, especially if there's enough volume traded. You know, you keep it within a market of people who understand things. These days you got people trading Brent very confidently and dated Brent very confidently, because they know, or at least even if they don't know, what is true is, with the addition of WTI Midland and all the adjustments we were talking about, like it's quite a fundamental market now again. Like these dislocations and distortions people used to talk about quite a lot over the years, I don't think are going to be that common anymore, or at least they're a lot less common. And that's good for anyone wanting to trade paper, right? And cash settle contracts, like you were saying, Ehsan.
Yeah, I think that's a clear, there's a clear sign of like the strength in the market, and like, you know, refinery margins, looking at that, like it is behaving very fundamentally. And but going back to like, you know, all of these mechanisms, like all these smart ways of doing this to create confidence and like making contracts cash settled, I think these are all learnings for the future commodities that are going to get like traded, like hydrogen, like ammonia, like all of these other you know, commodities that are going to be needed across the globe, and creating those benchmark across like different regions as well, to allow the traders to utilize these and to start like, you know, making these commodities move around the globe, and that brings, you know, more interest and more opportunities, and like eventually like you're going to have like a proper market that you would see the supply of these important commodities across the globe. So there is a lot of learning, I think, from the oil market and all the mechanisms that has been developed over the last 30-40 years.
Ultimately, this is quite important, because previously in the oil markets it was just dominated by the trade houses, right? As Javier Blas and Jack Pachi explained in the World for Sale book, you know, it was all about knowing these, having like access to information, you know, having this right connections and contacts with governments. You know, they knew things way before other people, but now with the democratization of information and also the movement towards, you know, more futures markets, cash settled benchmarks as well, it's you know, now oil markets accessible to many more people, many more traders as well. But ultimately, of course, you have its functions for speculators, but the ultimate purpose is, you know, especially with the cash settled contracts, it's for the actual producers, you know, with actual products, with skin in the game, to hedge their basis risks, to you know, get a, you know, generate a consistent cash flow. And that's, you know, of course they can trade their stuff on the physical, but they need to use the paper markets to hedge their exposure. And so with the cash, this is what the market is really functioning for, and the benchmarks aim to mirror what's actually happening in the physical.
I totally agree with that. And but I think at the same time, as well as like the hedging flow and like people needing these benchmarks, I think the average people, like in this day and age, they're a lot more sophisticated in terms of investing their money. And you know, the other day somebody asked me, how can I get exposure to like hydrogen, like if I want to like invest. And there's not that many stuff out there that allows you to get like a good exposure to these specific markets.
Would they want to be long the hydrogen?
Yeah, it's like
But that makes no sense in my mind, because the whole point is like you want to be, it's only going to be viable if it's cheap.
Yeah, but as in like,
If you get long it, it's like
it's more like hydrogen technology behind it, or like
so that'd be more stocks, right?
Yeah, it's like looking at maybe some ETFs that are related to hydrogen.
As in production of hydrogen.
Production of
that makes
hydrogen.
sense,
But like, you're right. As in like the actual price of hydrogen. But like some other stuff like lithium and cobalt and commodities like that. Again, it's not so easy to get access to these markets and have like exposures to these markets, especially for like an just an average person who wants to just like kind of manage their own like pension. And it's I think there's going to be like a lot of developments in this area with more retail access to these specific niche markets.
Cool. Well, I think we covered quite a lot there. So
we didn't cover the Japanese oil and gas industry.
What do you want to say?
Yes, let's give a quick run through. Since I was on.
Go on, 2 minutes.
2 minutes. 2 minutes. Quick summary. So I was in Japan for holiday in the past 2 weeks, and it's actually quite fascinating because being in the commodities industry, of course, there's a lot of discussion about Japan's role as in terms of their demand for oil and gas, and of course with the linking back to LNG as well as the benchmarks. Japan plays a big role in these benchmarks and contracts. For example, the LNG JKM, that's a Japan Korea market, aims to be a benchmark and indicator of demand for LNG in East Asia, and as well as looking at the mean of Platts, MOPJ, mean of Platts Japan, that's for naphtha petrochemicals as well. And what's important is because Japan, they are a huge net importer of oil and gas, one of the largest consumers as well. 97% of their crude oil are imports,
Right.
over 90% from the Middle East. At the same time, they also import most of their gas as well, natural gas via LNG tankers, because there's no pipelines connecting, from mainland Asia to Japan. So there's a lot of
The demand hub.
It's a huge demand hub, and that's why energy security is, of course, a concern as well. Interestingly, Japan has the world's largest regasification capacity as well, and then also the second largest importer of natural gas after China. And what's interesting is that overall, in the long term, demand is seen to be projected to decrease in both oil and gas, not only because of Japan's demographics, the aging population, but also because of the energy transition. They're switching to more solar and nuclear energy as a way of generating electricity. So of course that would reduce their demand for both oil and gas as well. But of course and then at the same time last week there was a typhoon that went through west central Japan, and of course a lot of our focus is on how the Atlantic hurricane season will affect refineries in the US Gulf Coast as well as the West Coast, but we actually crossed paths with Typhoon Lan last week, and looking at the news, actually there wasn't much disruption to the actual refineries itself. They continued to produce, but it had partially suspended oil product deliveries in West Japan's Kansai area because of rough sea conditions and strong winds. But the typhoon itself was relatively weak at Category 1, but in the past there has been bigger disruptions as well to refinery production, but also shipments as well. But I believe that the effect to the markets, that's we need to do a bit more of an investigation as well on that, how that affects, MOPJ, perhaps the gasoline east-west.
So one thing
and
I
all
was going
that.
to say, like, so you said like for crude and LNG, crude and gas
Yeah.
generally, like they import.
Mm.
Do they have enough refineries for like producing the domestic products?
Yes, so the refinery capacity comes to around 3 million barrels per day. There's 22 located around the country, and on average, I believe the demand is around 3.5 million barrels per day. So there is certainly enough refining capacity, and Japan has emergency oil reserves as well.
Right.
So there is sufficient capacity, but energy security is, of course, a big concern as well. So they do have a lot of.
They still
projects
need to
related.
like import some products too, right? Because that's the capacity, and then
Yes.
they've got to still import some products like gasoline and diesel and naphtha and
Yes.
as well as the production.
They will have to, but
Yeah.
there's strong refinery capacity to process all of the crude, but there
Right.
has to be a little bit of oil product imports as well.
Right.
Of course, as for LNG, that's they got strong a lot of regasification facilities as well.
Right.
But it's interesting seeing that in Japan there's a lot of trade houses as well. For example, like Mitsui, Mitsubishi, and all of these. That's based on Japan's corporate system. A lot of conglomerates.
Yeah.
They focus on not only commodities but
It's like a heaven for them, right?
Yes, manufacturing and all of that as well. So,
Yeah.
you see like the Trafiguras and the VTOLs, all of that. But I think the Japanese trade houses, it seems that when I'm following the markets, they are less mentioned in these, the window trades and all of that. But it does seem that they sort of have the similar function to the other trade houses as well. When you compare that with China, that's more, okay, it's just purely like Unipec, Sinopec, Sinochem. They're just purely oil or gas companies. For example, look, you talked about how
state-owned. Yeah.
state-owned, like Beijing Gas and all of that, starting new entities. But for Japan, yes, you have that, but they're more as part of like corporations, as part of like a wider, one of like many divisions and one of many other industries as well.
Yeah.
Of course, you do have the ENEOS, which is purely an oil and gas company, though.
Yeah.
All right, thanks guys. Thanks for listeners out there. We'll be back next week for more. Thanks again.
Thank you.
Cheers.